Capital gains tax in Spain. What you need to know. Welcome back to Spainguru. Today we're diving into an essential topic for anyone considering moving assets or selling property when relocating to Spain. Capital gains tax, CGT. Understanding how this tax works and planning accordingly can save you significant money and stress. In Spain, capital gains tax is applied to the profit made from selling your property or other substantial assets. The rates start at 19% and can go up to 28% for higher gains. Importantly, this tax isn't just about property, it extends to assets, transfers, and donations as well, meaning any change in ownership can trigger a tax event. Here's a quick breakdown of the CGT brackets in Spain as of 2024. As you can see, you have several brackets starting at 19%, then going to 21, 23, 27, and up to 28%. This is how those brackets would work for a 100k taxable capital gain. To calculate the effective tax rate for 100,000 euros capital gain in Spain, you would apply the different tax rates to the respective portions of the gain within the brackets. For example, the first 6,000 euros is taxed as 19%, which equals 1,140 euros. The next 44,000 euros from 6,001 cent to 50,000 euros is taxed at 21%, which equals 9,200 euros of tax. The remaining 50,000 euros for the bracket from 50,000 euros to 100,000 euros is taxed at 23%, which equals 11,500 euros of tax. Adding this together gives a total tax of 1,140 euros plus 9,240 plus 11,500 euros equals 21,880 euros. That is 21.88% effective tax rate. If you're an expatriate moving to Spain and sell property in your home country, you'll be subject to CGT in Spain if you qualify as a tax resident that calendar year. You are considered a tax resident if you spend more than 183 days in Spain during the calendar year from January 1st to December 31st. These days do not need to be consecutive and can be under any status, such as a tourist or visa holder. Simply being in Spain for over 183 days within the year establishes you as a tax resident. But it's not all straightforward. Timing your move can be crucial. For example, if you arrive in Spain later in the year and stay under 183 days for that tax year, you might avoid becoming a tax resident for that period, potentially saving on CGT in Spain for that year. Deductions can also lessen your tax burden. Costs related to the acquisition and sale of the property, like notary fees and legal fees, can be deducted from your taxable gain. Losses can also be declared and offset against other capital gains. For those looking to reinvest, Spain offers a significant incentive. If you sell your primary residence and reinvest the profits into a new main residence in Spain, these gains may be exempt from CGT, provided the new property qualifies as your habitual residence. However, keep an eye on recent updates like the changes to the municipal capital gains tax. Following a constitutional court ruling, taxpayers now have more flexibility in calculating this tax, which can affect your overall tax liability. If you're over 65 years old, and sell your habitual residence in Spain, where you've lived for at least 3 years, you could be exempt of CGT. Also, for properties bought before 1995, a substantial reduction applies, though this only covers gains accumulated until January 2006. In conclusion, while capital gains tax in Spain can seem daunting, proper planning and understanding of the tax laws can mitigate its impact. Whether you're selling assets before or after moving to Spain, consider consulting a tax advisor to navigate these waters effectively. It's not just about understanding the rates, but managing the process to align with your financial and living arrangements optimally. Oh, and one more thing. Apparently YouTube says you're gonna love watching this video right here. I think you should watch it.